Welcome to the Commercial Real Estate Podcast powered by First National. I am Adam Pawadic, sitting here with Aaron Cameron. I want to thank Kingset for sponsoring our video speaker series. Normally, this is the point where I would introduce the guest, but this is going to be one of the rare episodes where we don't do one. We are recording at RealCapital all day, and technically Aaron did come fresh off a panel just 10 minutes ago, so he's armed with a bunch of new knowledge he wants to share. Theoretically, but it is just going to be the two of us. The vision we have for the conversation today is just lending. This is, of course, RealCapital, and RealCapital does cover both the debt and equity side of the equation, but debt seems to get a lot of play usually at this conference. We're lenders. Seems like a perfect fit for us to spend 30 minutes talking about our favorite subject, lending money.
Yeah, well, and shamelessly, we don't really get a ton of opportunity to talk about it unless our guests bring up how they finance their investments, simply because we don't typically invite lenders to come on our platform to talk about their lending platform, if that makes sense. So
it might be intentional.
Yeah. So I think really what this is just an opportunity to cover all different aspects of the real estate industry. And we don't really get a chance to talk about lending exclusively as an episode.
We do get the chance when we do the after show. And for those of you who don't actually know, we do an after show. When the main interview ends, listen for 2 seconds longer, and it'll kick into the after show. And there we are, just Aaron's mind thought. There we'll get into lending because there's just you and I talking. That's our fair space. But yeah, that's only usually about 5 minutes long. So this will be a nice dose of 30 minutes of interest rate talk.
Or less if we run out of things to talk about. We discover that we're not as smart as we think we are. So let's jump to my panel first, I guess. February 27th here today at RealCap. And the panel I was on was alternative lending, which I have a problem with because I'm not really sure what that means. It means non-bank lending, but the banks aren't really that active in commercial lending. So it's kind of a misnomer.
The banks are the alt space. Is that what you're saying?
Well, yeah, I mean, the banks will lend to 20 people that are the largest and most sophisticated, but there are way more than 20 people borrowing money in our Canadian environment. It was Justin Walton from Kingset, Eric Horry from Trez, Casey Chowan from EB, and Leo St. Germain from MCAP. So a good cross-section of individuals. And the topics were basically, and this is how we're going to have the conversation today, was what's going on today in the environment, how has our underwriting changed to adapt to today's commercial real estate environment, and then what are we doing kind of in the future? What are we thinking about the future? What's going on?
And I sat near the front and took a prolific amount of notes.
I'm impressed by the number of notes you took, by the way.
Yeah. I can recreate most of that conversation.
Yeah, you really, more than I remember, I'm sure, yeah. When you're standing up there doing it, you're so focused on listening. It feels like, and this is the truth for podcasts. Here's a tangent. Well, it's just you and I. We sit here and we listen to these individuals, saying lots of really intelligent things. You have to focus really hard on what they're saying to make sure that your next question isn't a repeat or you don't sound like an idiot. But it's funny, when you're so focused on listening, it's really hard to retain what they said.
Agreed.
You know what I mean?
Yeah. Oh, yeah, 100%. Yeah, I always find when we go back, if I go back and listen to an episode for whatever reason, it's nice and relaxing. I can actually absorb what they're saying, and I don't have to think about, yes, I'm paying attention to what they're saying. Plus, in about 45 seconds, if I don't say something, there's going to be silence on
the harder you listen, the less you hear, if you want to sum it up. Anyway, so I just did that panel, and I don't remember at all what was said up there. So you can do it. Okay, so current environment for lenders. And we'll summarize kind of what the group was saying on the panel, and I think from our experience at First National. Here, I'll do this just for the listeners that maybe not are avid listeners, and the reality is we don't do this as often as maybe we should. First National is the largest commercial lender in the country. We do over $10 billion of new originations each year. That doesn't include renewals or extensions or anything else.
Or single family, to be clear as well. That's just the commercial.
That's just commercial. Yeah, thank you. So that's just commercial. $10 billion annually, new origination. We have over $50 billion under admin, which makes us by far the largest originator of new mortgages and by far the largest servicer of new mortgages. We have over 100 active construction loans currently for just under $5 billion of active construction commitments. So that makes us the largest construction lender in Canada. We ultimately have a plethora of capital sources. We have institutional investors that we place these specific mortgages with. We have our own financing available. We have our own capital that we deploy. And then, of course, we also securitize a lot of our mortgages into the Canada Mortgage Bond Program through the NHMBS market. So we do a lot of CMHC. I would say 70 to 75% of that business we do is CMHC insured. But even though only a quarter of our business is conventional, that's still $2 to $2.5 billion a year of conventional financing, which I think also makes us not the largest conventional lender in the country, but still way up there.
A big player.
Yeah. And so for context, when we are talking about what's transpiring in the lending market, and we do have a pretty good breadth of access to the information, and just obviously, I think this goes without saying, that's across the country in all asset classes, in all geographies, everywhere. So what's going on?
The discussion, I have a lot of takeaways from the panel. It was nice just sitting there relaxed, not having to have any pressure to speak. The common themes that came up over and over is increased DD, sponsorship matters, experience matters. Those are kind of no-brainers. Everybody, can think about that. But what does that actually mean in practice? Of the equation of there can be problems in the property, there can be problems within the borrower. All issues that lenders are currently dealing with tend to be on the insolvency side, not necessarily the asset failing kind of side. What does it mean for trying to get a loan done? Liquidity matters. And liquidity, of course, would be separate than net worth for anybody who kind of doesn't regularly do this stuff. That's the ability to cut a check in short order. Not that you have a bunch of money tied up in land and it's inaccessible. It is you need an emergency Band-Aid financially, and you can get that done. Some of the more interesting comments were that some of the lenders up there would consider, if they're looking at a 3 or 4 year construction loan, that they would consider future cash flows in the equation. I thought that was both on the plus and the negative side, because if you have a bunch of projects completing over the next year, well, then maybe you consider that from a credit perspective as being good things. You're getting cash infusions. Conversely, if you have 4 or 5 projects launching in the next little while, it means you're about to dump a whole bunch of equity into those projects in order to get going. So it's not just as simple as, hey, we want to see a certain percentage on the the net worth side and we're good to go. That they're really looking deep into that. One of the lenders mentioned that typically liquidity is concentrated in the major urban areas. They are seeing strong liquidity up to an hour drive away from the major urban centers that they're active in. I thought that was kind of a interesting insight, that you're not dealing with mom and pop shops if you're an hour outside of a major urban area. Monetization schedule. That was the word. I was trying to figure who put it most succinctly. Monetization schedule is what they look at to manage those kinds of cash flows.
What I thought was telling, and not surprising, again, given what we are doing at First National, but it was nice to have it substantiated by our peers, is the amount of due diligence done up front. I mean, certainly that you hear more focus on liquidity and sponsorship strength. I think, again, 4 years ago, it was still important. It was still something you had to have, you had to look at. But I think if a client said, I know, here's my net worth statement, I've got $3 million in a bank account, you kind of go, okay, awesome. Yeah. Now you go, okay, cool. I want to see that bank account. I want to see 3 months of that 3 month statements of that bank account, like prove it, right? There's an additional layer today to make sure that, whatever you're stating you have, you truly do have.
Or somebody shows up with an appraisal from late 2022 on not on the the asset you're trying to finance. Obviously that requires a new appraisal, but they go, hey, I have this other piece of land or property or whatever it is, and it's worth $10 million. Yeah, I had it appraised a year and a half ago. And you go, well, maybe we should underwrite it because I don't know that appraisal is valid anymore. Whereas to your point, a couple of years ago, it's probably worth $10 million. We're good.
Yeah, I think the other angle on this is just portfolio reviews. It's kind of thing where someone again would show up and go, I own 10 buildings and so it's worth $100 million. I got $50 million of debt, so I'm worth $50 million. Or there's my asset value. And you kind of go, okay, great, thanks. And you kind of file that in, and that's what you write up. Now you're going, okay, cool. Show me operating statements and rent rolls for all of those assets, and I'm going to do it myself. And I'm going to underwrite it. I'm going to apply my cap rate, and I'm going to, and by the way, I need to know what your maturity profile and all of that debt looks like, and I'm going to underwrite what your new interest rates will look like in a year or two as those mortgages roll. So I'm going to get myself comfortable with what your portfolio value is, what your true equity position is, and what your cash flow looks like in the next couple of years. I'm not just taking it on face value. There's just a much deeper layer of due diligence. To tie this all in, if you think about lending, and maybe this is lending 101 to a little degree, the vast majority of us are cash flow lenders, right? And what that means is there has to be the durability and stability of the cash flow from the asset to make the mortgage payments. And so you want to make sure that the asset is there. What we're finding in this new environment is we're all being reminded that sometimes that's not good enough. And sometimes there needs to be cash infusions, particularly on the development side. Maybe we go there next. But even if it's a cash flowing asset, sometimes there's just the need for the borrower to have liquidity to make payments if the cash flow is disrupted or whatever it may be.
Tenant leaves, you need major tenant inducements to the new one in.
And again, in history, at least in the previous cycle, we just maybe forgot that, or it was just so easy for borrowers, real estate owners, to refinance this or add a second mortgage there, or there was cash flow coming from a bunch of other assets, and it was such a positive tailwind environment. You weren't necessarily worried. You just kind of assumed they were going to have the cash because everybody was just generating more cash flow and more cash flow. So now all of a sudden, of course, in this new cycle, there's much more focus on do you have the cash today, and will you have the cash in the future when you might need it on this asset?
Well, that was one of the panels kind of brought that up, that you do a 12-month loan, and then all of a sudden 36 months you're still into it, and you've done multiple renewals. We'll call it against your will. And so it is it's easy to get into a mortgage, but getting out is becoming more and more pointed. I mean, that particularly was reference to a land loan, but that would be applicable to kind of any asset class. It is not part of the chosen children right now, which would be core industrial and multifamily.
Before we go on, I can feel the listeners going, "Oh, you guys are so conservative."
Yeah.
And true, yeah, that you're absolutely right. We are. On certain vehicles, like if it's a CMHC insured product, like after all said and done, we're making 20 basis points. Like I'm not making the 5% interest rate because I've got securitization costs and all these other overhead costs. Like I'm actually making a tiny little spread.
And that's our max upside. That's assuming everything goes well with the mortgage, right? And
so like when you think
our downside's enormous.
I have zero risk tolerance for loss, like zero. Like you do not lend dollars if there's any chance you're going to lose that money, because you're not making any money on that money going out. Like it is a margins game. You have to deploy hundreds or at least, hundreds of millions of dollars at a very thin margin to make any revenue. If any one deal goes sideways and there's a loss, the whole thing is wiped out.
Oh, yeah, it can wipe out so many good loans.
So if you're just sitting on the equity side, and let's say you're listening to this right now and you've been in the equity side your entire life, and you're thinking, like your target's 15 to 18% at the end of the day. So you have some fluctuation. Like you can do 10 projects, miss on one of them, the other 9 were good, and you're still pretty good. If I do 10 loans, miss on one of them, like I'm getting fired immediately, and the business might go bankrupt because I'm not making enough money on the other 9 to carry that one. It's the other way. I got to do 100 loans. If 99 are good and one's bad, even that might not cover me. Like it's a totally different equation when deploying this capital. And so when we sound conservative, it's because we're not making any money on this stuff, like very, very minimal.
Yeah, for the lenders in our space. I mean, obviously, there's lenders in the space doing higher interest rates to reflect some of the riskier stuff, and there's a little room for mortgages going off. But I mean, I'm sure everybody's familiar with interest rates that go along with that kind of consideration. If you're looking for best in market pricing, and you need kind of
that's a good point. Like if you're borrowing from a private guy at 12%, that's probably his money, and he's earning 12% on his money. Yeah. If you think about though, like a lot of the lending institutions, like take like an Equitable Bank, for example, who's a partner and a friend of First National's. They're raising capital through GICs, so they're paying out whatever it is, 4.5-5% on every dollar that they lend. So if they're making if their interest rate is 6%, they're going to pay 5% for that access to capital. So their spread is minimal, right? And so you think, well, you're making 6% of your money. No, they're not. They're making just a fraction of 6% on their money.
Yeah.
They're lending to you. Well, in turn, you're making whatever it is, sort of 15-18%. So
I've had borrowers say to me before, like, oh, you must love this high interest rate environment. I'm like, no, it doesn't work like that.
It doesn't. And that's, I mean, we've said that before on the podcast. Yeah. Like interest rates could be 20% or 1%. Like the margin we make is basically the exact same.
Top. And people are more interested in mortgages when they're 2%, like they were in 2020, than than currently.
Yeah.
So
Which,
it's-
which
yeah.
to be fair, is a good thing for us. As long as there's people borrowing the money, the business just keeps rolling. There's not a lot of ups and downs as far as just the consistency goes. If you always get your money back,
Yeah.
if the loan works out well.
There was a number of CMHC participants on this panel, and so Select came up in a big way. And just for anybody who's not up to speed in the multifamily arena, and sorry for anybody who's not in this space, because we'll probably spend the next 10 minutes talking about that. Select is a new CMHC insurance program that was rolled out in March of 2022. It rewards energy efficiency, accessibility, and affordability with enhanced loan criteria. And at a lower cost to access it. And so it's been a very big success. Aaron highlighted as part of his, I think, intro to this section in the panel that, conventionally, meaning there's no government insurance program in place to cover the lender, that we would never offer these same terms on a conventional basis. No lender, would. And it's been very effective. And then, this has been where, I'll quote, that's where the action is, I think was the exact phrase used on the panel. And it's been a godsend to multifamily. Multifamily construction's continued through this interest rate increase environment, pretty much unabated. I mean, obviously, there's been some groups that have slowed down, but most are still breaking ground on their projects and moving ahead. And that's got to be largely due to Select. Just kind of back of the napkin math is you're losing 10, 11, 12% LTC on a loan, which is, very, very bad for return if you have to make that up with your own equity, especially depending on what that capital costs. There was we had a in-depth discussion on that. I guess some of the pros. If you knew the pros of what the Select program would offer, I guess one of the cons that brought up was that in some markets like Ontario, the affordability criteria is a little tougher to make work given the accompanying land cost here.
Well, explain how to qualify for the affordability.
Yeah, so you need to be at 30% of the median renter's income, and it's an important distinction to note that median renter's income does not include housing in your local area that is owned by homeowners, because that's typically where you're going to find higher salaries, skewing that number up. So as an example, if you're in Toronto, the rent number is $1,347 per month is the rent figure. And then you have, of course, land going for multi-millions per acre, and it gets tougher to pencil out to qualify via that metric. So there was some criticism of the program, and right or wrong, that's the way it is. But overwhelmingly, it's been the driving force behind keeping multifamily going in an era where we cannot stop talking about affordability, lack of units, undersupply, on and on. So, yeah, I mean, the where the action is quote is accurate. That's a huge part of our lending volume, and it came at just the right time too, because the interesting part was it launched, I think March 7th or 8th of 2022. Days later is when all of a sudden we go, hey, what's going on with the bond yields? And then fast forward to now, and we're hundreds of basis points up.
Yeah, it has allowed a lot of developers to keep the lights on, keep the program moving. I don't know the exact number, but a good significant portion of our $5 billion of construction money is MLI Select. And only because, one, because we were actively, selling that product, but two, because it was the only product that made sense for that developer. Otherwise, the project's just not going forward. It wasn't, hey, they selected Select. They didn't pick Select against something else. It was the only option in order for that deal to make sense.
I couldn't imagine a world where you had side-by-side options and something else.
Well, it
made
wouldn't have
more
been.
sense.
Yeah, it used to be that CMHC. One of the shortcomings of CMHC was you had to pay the big premium. So guys used to say, "Well, I got to pay the big premium, but I get this," and there was a wait. With MLI Select, the premium is minimal. Plus, you get the 50-year AM. Plus, you get the often you can term out without rental achievement. Plus, you get the 50-year AM. Plus, you get the 110 cover. Like, there's just so many things. It just made it a no-brainer. Yeah.
All right, we're going to move off of multifamily for anybody who's not. We did talk about, what alternate asset classes, the weirder asset classes, the when the student housing, like that kind of stuff. And so the comment there that is when you think about it, of course, it's super evident. But there, the experience, like sponsorship course, meaning you have financial capacity, that's important, obviously. But the experience component gets that much bigger when getting into those kinds of asset classes, because those are less set it and forget it type real estate. That's not you just, renting you a McDonald's, collecting a check, and that's it. I mean, the operations side of it is enormous. And if something goes wrong with the property, any lender stepping in now has an operations issue on their hands in order to keep that cash flow coming. Aaron, do you want to repeat what you said about seniors housing on the panel?
Well, yeah. It's so back to just the concept of the cash flow focus, cash flow lenders, and there are some non-cash flow lenders out there that will take higher risk, and they're much more reliant on either taking possession and selling it or the sponsor. But that's not. If I when I say cash flow lenders, that's basically all of us, right? Like they're very little. It's got a negative trim. The loan to own concept, right? Where I'm happy if you go bankrupt because I'll just take your property over and I'll own it for 80 cents on the dollar, whatever it is I lend to you. That's a very, very small segment of the market. Effectively, every institutional lender in the industry is focused on the cash flow of the building, the durability and stability. I keep saying that, the strength of the cash flow of the building, and the ability to get your money back. Right, and those are really, like, if you wanted to hum it down to the sort of the core, make sure the cash flow is strong, make sure you get your money back. Sponsorship, of course, is part of that. The alternative asset class, what makes them complicated is it's a little bit less durable, less stable asset or cash flows, right? And so retirement homes is the biggest example where, much more subjective to, much more influenced by demographic changes, and way more impacted by the strength and the experience of the management group, right? A really strong operator can make an asset work, the exact same asset, the exact same scenario, and a weak operator, and the property fails. And so it comes down to the experience of that operator. And the reality is there are not many really good operators out there in the retirement home space. And so, we've got resident expert Brian Kimmel at First National, former guest of the podcast. Maybe we haven't have him back on now. Now it's been a number of years, where he gets approached regularly by apartment owners. So strong real estate people who own a bunch of assets, who are looking to diversify their portfolio, or looking at retirement home yields, saying, hey, like, there's some healthy yields there. Maybe I want to get into that. And they approach him for some guidance, and he just says, do not do it. Don't do it. You will fail. It will end up as a catastrophe. You will lose money because it's just so hard. And to think about it, like, I don't know if you haven't walked retirement home recently, but it's like a little mini hotel, except it's not nightly. It's daily. It is kind of still daily because you've got to make sure that
meal service,
room cleaning, and then they add a nursing home layer onto it, and then there's a dementia care that can be part of it. There can be all sorts of assisted living components to it, and often those things are on different floors, and there's different components, and there's unionization, to deal with on the employee side. Like it can unravel if you're not really strong as an operator. It can unravel really, really quickly on you. And so and we do participate in the retirement homes quite actively. Like I know we are also the largest retirement home lender in the country by far, thanks to Brian and his relationship with the clients. So it's something we do quite actively, and yet it's only with the top 5 in the country, because those are the only 5 that we really believe it can manage the assets appropriately.
I've said similar things on the student rental side, because, of course, that seems like an easy just kind of shift to the right if you're an apartment operator and now you're student housing. And people get attracted to the fact that you can generate considerably higher rent per square foot on a student basis. I said, well, yes, but like, you're going to earn it. It's not a free pickup. You are definitely going to have to earn it with that asset class. The differences are, your leasing game better be on point, because you have to lease the entire building every single year.
Yeah, and go to storage. I mean, storage and student housing kind of have similar patterns to them, right? A lot of turnover, a lot of constant leasing.
Repricing constantly.
Yeah, more operations. You need to have sales features and all sorts of stuff going on. So it's also can be complicated. Can be done really, really well. Again, we're not saying we don't do it. Yeah. It's just it adds. There's some other sort of nuanced data centers. Sorry.
It's been a long day.
Yeah,
it's okay.
Yeah, I'm running out of steam here. Data centers is another sort of alternative asset class that I think is getting that does get a lot of attention. Problem with data centers is the leases don't make any sense. And if that data center tenant is not there, the value of the property comes down tenfold. So it's really complicated. And then hospitality, of course, which is another one. Hospitality and retirement homes are very, very similar. Again, back to that durability and stability of cash flow. When you're lending on these things, it becomes much more you have to be much more confident with the individual, the team that's running that building, that they can keep that cash flow from going.
Well, the funny conversation, when data centers first started kind of popping up as loans, I mean, at least in my window, call it 10 years ago or so, the first question is like, well, what happens if you had to, release it as industrial? It's like, well, the rent's going to be 1/10 what it was prior. There's no way around that risk. There's no underwriting into that kind of, resolution, right? It's just, like you have to be very comfortable that all of a sudden your usual metrics don't make any sense. The per square foot valuations, the per square foot rent, the lease terms are forever. There's a number of things about it that kind of get a little offside, and you're either comfortable with it or you're not. It's it's a strange one.
Yeah, I mean, back to what we talked about earlier. From a lending perspective, you got to understand. We're a conservative group by nature because you don't have defaults, right? If you have defaults, that's a fail. Like it's a very different industry, different part of the industry than the equity side.
We talked about land loans. Well, not we. I was an audience member. Sorry, you talked about land loans. Land loans. The kind of feedback was, it ranged from absolutely not under any circumstances, I don't care, to yes, selectively for our best clients. Maybe we'll look at it. Land's still a major issue. Yeah, the kind of no-fly zone that came up was the office to res conversion. It wasn't a no-fly zone, but just there's inherent risks. Building, from scratch is very predictable-ish in the costs. Start opening up walls in an old building to do an office to res conversion, very, very difficult. You need to have a sponsorship that can cut very large checks in the event of very significant cost overruns. And the panel kind of alluded to that there's more people looking at it than actually doing it. Like the ratio of people looking at it and kind of kicking the can on it, a little off.
Yeah, I don't know what to make about that. I mean, just skipping around, like leaving lending aside for a minute. I mean, I think, lending on it will make sense for the right product, for the right project, on the right asset class, for the right sponsor, with the right experience. For sure, you can wrap your head around it. I think someone said they did a study, and there are 1,600 office buildings that are ripe for residential conversion in Canada.
From a physical layout perspective and location. And
But, I mean, that seems like a ton of opportunities, and yet we're not seeing we're seeing almost none, right? Like there's a handful circulating right now.
I'd be hard pressed to name 3 that I'm aware of that are actually going ahead. And not to say there's not a lot happening, because it's a very big country, but
I think it's a lot harder than people make it out to be.
Maybe the last topic before we jump off, ESG and lending. Canada as a whole has lagged other places, Europe in particular on the ESG front, and lending is no different than any other area of real estate in this country, and that, we're also kind of lagging. There was discussion on the panel that, some lenders are starting to look to make it part of their platform. It is part of the regular questions. What's your ESG strategy? There might be incentives lined up for that if you do have a strong policy. But then the counterpoint kind of argument was, maybe we're just going to wait and see what the leader does, and then we'll all copy that later. So we're still in the point where, the incentives, I don't know that it's, some game changer in your returns if you have an ESG platform. When financing, the rewards might be pretty small at this point, but, it's signs that it's changing in that direction. There are likely to be larger and larger incentives, and then eventually at some point disincentives not to have it.
Yeah, I mean, let's play the game, right? So institutional investors want to invest in debt capital, say ESG is really, really important to me. If you want my money, you got to have an ESG platform. Okay, so the lender goes, okay, I have an ESG platform. I'm going to ask my borrowers what their ESG strategy is, how they're impacting or how they're working towards sustainability and net zero, carbon neutrality on their buildings. And I'm going to collect all this information. Okay, so investor partners, now that I'm collecting that information, do I give a discount to my borrowers if they are achieving these things? And I don't think the answer is yes yet. They go, no. ESG is really important to me, but I'm not willing to offer a discount in the interest rate, or my capital doesn't become cheaper if it does achieve or meet sort of my sustainability criteria. So there's still a bit of a disconnect. But the fact is, it's really important to all the institutional investors investing in debt capital. It is, and it's becoming important to us lenders who deploy that capital, and it's important to our borrowers because I think they've got institutional investors, probably the same institutional investors, saying it's important to me to get your money. So it's coming around. I still don't see how it all links together, though.
Yeah, or heavily discounted green bonds or like any of that stuff you're not really seeing. Like I've heard in the marketplace maybe a 5 basis point discount on spread. You know, if you have a certain energy efficiency criteria. Of course, this talk does not include Select, which we already talked about earlier. That does have very significant.
And there's federal government basically subsidizing that side. We're talking about more on the conventional side of the business or the uninsured.
And 5 basis points on many millions of dollars is not nothing, but it's not a game changer for your return to deploy a big strategy. So. Yeah,
I want to finish off on interest rates. But last thing on ESG, I mean, First National is a proud member of GRESB and sitting on the North American Lender Committee for just how we figure out as a community to weave in this ESG challenge. Like I just said, I don't know where all the threads sort of meet so that we're all incented in the right direction. Where borrower achieves strong sustainability, benchmarks, I lender then give them cheaper money. I lender get cheaper money from my capital, right? Like I don't know if it's all flowed through yet,
and like significantly too.
Yeah, enough where it's meaningful, and so therefore now I'm incenting borrowers. Go, geez, I better make sure this is a focus of mine because therefore I get cheaper financing. It's not there yet, but we're working on it.
So, one last question then before we go: what quarter are we going to see the overnight rate come down? No qualifiers. Call a quarter. That's all I want.
Q2, but
Q3 for me.
Yeah, Q3. Okay, so it'll be June 29th. We'll both be right, or June 30th. We'll both be right. That's where I want to go, and this is just quick, and then we've said it before, but just okay. Everybody, picture a curve going downwards from the left to the right. Okay, so that's what we would call an inverted curve. So on the short end, interest rates are high. On the far end, the long end, interest rates are short. Okay. That curve, that inverted curve we have is abnormal, right? It's supposed to be that on the short end, interest rates are short, are low, and on the long end,
underlying bonds are low. Yeah.
On the long end, the underlying bonds are long, and that effectively means the longer I put my money out in a bond, the more money I expect back because I'm giving you my money for longer, right? Basically, in a really simple format. So this curve has to what we would call steepen, right? Like it has to revert. It's inverted right now. As those interest rates, those short-term interest rates come down, I'm not saying that the long-term interest rates have to go up, but they're not coming down with it.
Yeah, not the same way.
They're not the same. So I'm just putting this out there for those that still think that, I can't wait for the prime rate or the overnight rate to start coming down because my mortgage rates for my 5-year or 10-year CMHC mortgage are going to be cheaper. I don't think that's necessarily true. It might. Maybe I'm wrong, but it's probably not. So if you're sitting here going, okay, well, Adam just said Q3, Aaron said Q2, I can't wait. I'm going to get my mortgage renewed in June or July and take advantage of new rates or lower rates. I'm not sure that's going to happen.
Well, at the very least, I mean, so many of our mortgages are priced over bonds. The bonds have already factored in the overnight rate coming down sometime this year. Like unless you were borrowing at a prime rate, and prime rate typically changes the day after overnight rate does, then yes, you'll be looking for that relief that comes up.
Yeah, if you're borrowing on floating rate mortgages right now, you can't wait for that stuff to come down.
That's going to be a big day for you. But I mean, if you're borrowing on a bond, based mortgage, I mean, you've already got the relief that it's going to provide later this year.
Yeah, like we hear the questions, and maybe just to finish this off, we have a lot of mortgages renewing maturing in 2024. I think a lot of borrowers are trying to figure out, what do I do? Do I do a 1-year term to take advantage of lower interest rates in next year? Do I just take a 5-year term now and just accept what the current rates are? Who knows? I guess I'm not saying it's not going to make a difference, but I don't think as overnight rates come down that the 5-year or 10-year mortgage rates will come down with it. I'm not saying they'll go up. I think it stays flat. So sitting here in a year from now, overnight rates come down a couple hundred basis points. I bet you the 5 and the 10-year rates are the exact same, give or take a little.
Yeah, and we're parked right in the middle of historical bandwidth.
You're right.
Where we are now.
So the curve steepens or reverts, if that's the language, but that means the bond yields on the far end, the 5 and the 10-year sort of bonds, stay where they are today.
So the people that watch the video component of this, they had an easier time understanding what you're talking about because you were doing a lot of hand signals. The audio-only listeners, They did not quite get the same effect. So,
Get a
but
pencil and paper out. Listen to it again.
yeah, but I think it was pretty clear. Yeah, it's yeah. Is that
Let's wrap it.
We've emptied out our brains?
Yeah,
from,
that's enough. I got nothing
interest
else.
rate talk. Okay. I hope everybody enjoyed just the episode. Aaron and me only. We've only done a handful over the years, and maybe we'll do more because this is a topic.
If you liked it, leave a review.
Yeah, there you go. Rate, review, subscribe, all that stuff. I want to thank First National for powering the podcast, RealCapital for sponsoring the video speaker series here at RealCapital 2024. Of course, our wonderful hosts, the Real Estate Forum. And normally I thank our guest right now, but instead I'll thank my co-host, Aaron.
Yeah. Thank you, Adam.